However, it may not pertain to you because your situation might be very different from what I am going to be presenting today. So in order for you to take any kind of tax position on your tax return, you must have a written statement from me, basically letting you know that, yes, based on your personal circumstance, you may use this tax strategy specifically designed for you with your own circumstance in mind, okay? So, but if you had a home office, the same miles would be considered a tax write-off. Make sense, everybody? Okay, so now I'm gonna go over a few questions and how I would address them. My CPA told me that if I don't have any income in 2020, I can't have a home office deduction. True or false? The answer is false. And why this is a very bad advice, okay? Oops, this is too fast. I want to give you a minute for you to read. All right, so your CPA is saying that you will not receive any 2020 tax benefit from your home office because you have no income, okay? That would appear to be true, but it's not. So let's go ahead and explain it to you. Let's say if you start your business late in the year, okay? Let's say you didn't think about starting a business until you get locked inside your home because of COVID-19. You go like, oh my gosh, okay, I don't know when I'm gonna be able to go out there and conduct my normal life again. And I'm really good at this. I'm gonna make it a business. The other day I was looking at somebody doing painting, right? So what he did was he recorded himself painting, you know, like watercolor painting. And he posted his video footage on Facebook. And he had a lot of views and reposts and likes, and, you know, people started asking him, like, oh, wow, this is so great. You know, like, can you show me how you do this? Well, he could actually run that as a business, okay? And he could actually turn that video into a YouTube channel and really, like, run a business of teaching people how to draw. There you go, right? Okay, so that's tax planning. You turn a hobby into a business, and eventually when he has enough subscribers on his YouTube channel, he's gonna get advertisement money, okay? Anyways, she's not my client. I just wanna share with you how, you know, I look at things on the internet and I can say, oh yeah, this guy can do this guy can do this, right? Okay. All right, so if you start your business late in the year, and you have expenses but have not yet received any income, because guess what? In order for you to get any kind of decent YouTube income, ad income, you need to have a lot of subscribers, and that takes time, period. I mean, it's not like you have a YouTube channel today and then tomorrow you're gonna have 100,000 people subscribing or 1 million people subscribing to your channel, right? So it takes time to build up your audience. All right, so in this case, you have tax deduction. Okay, because you have to go out there and buy a camera and, you know, to record yourself doing this water painting procedures. I don't know how to call that, right? So most likely, this guy's going to claim a tax loss in 2020, okay? Or B, perhaps you have a continuing business that simply had a bad year, right? 2020 is going to be a bad year for a lot of people. This morning, I just saw in the news that Sweet Tomatoes, the restaurant, you know, the all-you-can-eat restaurant business, they're actually closing the door. Imagine that, right? Like, we don't eat out often, but from time to time, like way back then, we used to go to Sweet Tomatoes all the time because they have really good selections of healthy food, and, you know, we like to go there and eat. Well, guess what? They're closing down their business, Sweet Tomatoes. Okay, and there are all the other businesses that are going to be closing as well because they cannot sustain their business any longer. So they're going to have to look for some other things to do, right? But in 2020, they're going to have a loss. Okay, so it's okay if you have a loss in 2020. this tax loss can be carried forward to the following year, 2021, 2022, so on and so forth, okay? So you do not need to have income in order for you to claim a loss, or in this case, a home office. If you do not have income, you still compute your home office expense, okay? You're not able to deduct it currently, but that will be carried forward into the future. So in the future, when you make money, when you have income, you'll be able to deduct the carried forward losses or home office losses that were generated in prior years. Does that make sense to you? But if you didn't claim your home office, then in the future, when you have income, you will have nothing to claim as far as home office goes. Does it make sense to everybody? Okay. If you have a tax loss from your business and you are told not to file a tax return, that's also a bad advice, because that tax loss can produce future benefits. See, a lot of people, you see, CPAs, right? You have a wide range of CPAs, right? And some CPAs are a little bit more conservative than others, okay? You have very conservative tax CPAs, and you have very aggressive tax CPAs, okay? But you ought to understand the tax laws, and you don't want to be extremely aggressive, okay? But at the same time, you wouldn't want to be working with a tax CPA that is so conservative, who wouldn't even want you to claim a home office. Like for me, when I talk to my clients, I always get them to a place where they could actually apply the tax laws in a way that would benefit them and not get them into trouble, okay? But if the tax laws are written in a way that give you that benefit and you don't do it because you're afraid for whatever reason it's going to be bad, or, it's going to raise a red flag, just know that the tax laws are written that way, okay? So if you stick to the tax laws, you'll be okay. And then, I also talked about the NOL, the net operating loss, and you're going to hear this all the time, okay? If you run a business, when the economy goes down, like the way it is now in 2020, most likely your business is going to have a loss, okay? 2 weeks ago, I talked about how you can actually carry back your loss. So let's say in 2020, you have a loss. In 2019, in 2018, you had income, you had to pay taxes on those 2 years of income. You can now amend your tax return in 2021, because you don't file your 2020 tax return until the following year, 2021. And then if it shows a loss, you can go back to 2018, 2019 and get a refund, okay? So planning tip number one, you always want to claim your tax deductions, even when you have a tax loss, okay? You don't want to do like what Dick and his family did, okay? By, like cheating on your taxes. But if you have a legit deduction, you want to claim it, okay? Always file tax return even if it shows a loss, okay? So number one, claim your tax deduction. And then number two, if it shows a tax loss, you have the loss documented. Alrighty, so the loss of business miles, we were talking about home office, okay? This is what I talked about. Without a home office, you have personal mileage on your trips from your home to your first business stop, and from your last business stop to your home, okay? So that's the reason why you want to have a home office. So in this example, you do not have a home office, okay? You have another office outside of the home. You don't maintain a home office. And so from your home to your client side, that's a 22-mile trip, okay? that is seen as personal miles, okay? So you cannot write off that. Let's say if you have a home office in the downtown area, and from your home office, not home office, from your home to your downtown office is an 18-mile route trip. Again, that is a non-deductible mile. Now, a lot of people ask me, how do I keep track of my mileage? There are apps that you could use. Like every time you get on the car, you turn on that app, okay, and you document it. It doesn't take you long. Or you can actually go and buy a mileage log book, either at Office Depot, Amazon. They're very, yeah, they come in a booklet like this, okay, and you just write down where you go every single day. That's how you keep track of your mileage. Now, if you don't do that, then it would be very difficult for you to defend your position that you drove 22,000 miles in a year. Because upon audit, the IRS would ask you, well, prove it to me that you actually drove 22,000 miles for business, okay? So I always recommend people either use an app to keep track of their mileage or use a mileage log book and just keep track of it manually. So when you have an office in your home that rises to the level of a principal office, then you treat the miles in example 1 and 2, which were mentioned earlier, as business trips, okay? So you don't have any commuting mileage, which I talked about earlier. So, but to make this happen, you need to claim the office in your home as your principal place of business. Okay, so today we don't have a whole lot of time. I know we only have like another half an hour left. So we're gonna hold all the questions toward the end, okay, everybody? Okay, so what constitutes principal place of business? So the current law gives you 2 ways to claim your office in home as a principal office. Okay. Number 1 is under the Supreme Court, finalized in Soliman. Okay. And then the second way, I call it alternative way, and this is a definition. Okay. It includes a place of business which is used by the taxpayer for the administrative or management activities, which I talked about earlier. Remember? At the very beginning of my presentation, I talked about admin and management activity, okay? So that is under the alternative method here, okay? Whereas the first method is under a Supreme Court decision, okay? So now, so what's the difference? Okay. There are 2 primary factors in determining whether a home office is a taxpayer's principal place of business. Number 1 is the relative importance of the activities performed at each business location, okay? And the amount of time spent at each location. So under Soliman, which is the first method, you have to make a cash register from your home office. Then you don't have, and you have an office in the downtown area, right? So you are not likely to make a cash register ring from your home office if you go under this first alternative, okay? So remember, there are 2 ways for you to determine if your office is a home office, right? Or a principal place of business, so therefore all expenses would be considered a tax write-off. So this is one of them. So if you're a plumber, if you do not have a cash register in the field, okay, then is that your principal place of business, right? And so those are the issues that this Supreme Court decision has to deal with, okay? So in this case, Soliman, if you spend 40 hours a week in your downtown office and only 12 hours a week in your home office, then you will fail the time test. Because you spend more than 12 hours outside of your home office, you see? And that's the reason why alternative number 2 came into existence, okay? So, so instead of Soliman, in 1997, lawmakers added additional words into this publication 587 that will allow you to qualify for home office deduction as a principal place of business if you use your office in your home exclusively and regularly for the administrative and management activities of your business, and you do not use your downtown office to conduct substantial administrative or management activities. Okay, so this is, I wouldn't say that it's new. You know, it's been going on within the last 20 plus years or so. Okay, but prior to 1997, most CPAs would rely on Soliman to determine if their clients have qualified under Soliman for home office deduction. Okay, and they totally unaware of the additional words that the IRS had since then added in their publication. So therefore, after 22 years, everybody would know about the alternative to Soliman, but we know that's not true because I continue to hear bad advice from other CPAs and EAs, not letting the clients take home office deduction. Okay? Oh, by the way, this home office deduction is available to you whether or not you actually have a legal entity in which you operate your business, or if you're just operating your business as a sole proprietor, okay, or as a corporation, okay? Now, when you operate your business as a corporation, you may not deduct an office in your home that you rent to the corporation. Okay, now in the tax laws, the rules will allow you to rent your space or your home to your corporation for less than 14 days, and the amount of money that the corporation pays you as rent is not a taxable income on your tax return, right? But only if you rent the space to your corporation for less than 14 days, okay? So, again, it's more of advanced tax planning, you know, for those of you who want to use legal entities to set up your business structure and maintain your effective tax rate in a way that takes advantage of the tax law, okay? But it's, you know, it's legal. Julie Wan last week talked about different legal entities for tax purposes, and there are reasons why people operate businesses in a form of an LLC, an S Corp, or a C Corp, you know, what have you. You could even have a corporation for legal purposes. You have a C corporation, but for tax purposes, you want the corporation to be taxed like a flow-through entity, right? So you're gonna make a check-the-box election, right? So you file a piece of paper and you tell the IRS, hey, I have a corporation, but I don't want to pay tax as a corporation. I want to be taxed as a flow-through entity. I want you to treat my corporation like an LLC, for example, or I want you to treat my corporation as an F corporation. So you put in a request, the IRS will review it, and they will approve it most of the time. You know, I haven't really seen a client not having their request be declined by the IRS, okay? And so from a legal standpoint, you actually are operating as a corporation which then shields your any potential liabilities. But on the tax side, all the income that this entity makes actually ends up on your personal tax return because it's a flow-through entity, right? Okay, so again, that is more of an advanced tax planning idea, but it's available out there, okay? Alrighty, another example, if you have an office in your home that qualifies as a principal place of business, again, if you have a home office at home and you do all the things that the IRS and the laws allow you to do or want you to do before you can take a home office deduction, this is what you can do. You can deduct your daily transportation costs between your home and another work location in the same trade or business, okay? Now, this does not apply to people who have a W-2 job and maintain an office at home and working from home, okay? I'm talking about people who actually run a business, who make money running their side job, okay? Not you as an employee working for Intel, working for Apple, and you work from home, right? So this does not apply to you. The laws changed in 2018. Okay, so now let's say you're driving a vehicle that costs you, what is it? I'm so sorry for the typo. Right now, for every mile that you drive, the IRS will allow you to take 57.5 cents, okay, as like a reimbursement, okay? So if you commute to and from your office 24 miles per day, 5 days a week, 48 weeks a year, that's $3,000 in new deduction that you can write off. Not write off, that you can get back, right? Because you take the total of miles multiplied by 57 cents, 57.5 cents, okay? So that's how much you'll get back in form of deduction, okay? So 4 weeks ago, I talked about the two-vehicle strategy. For those of you who missed that, basically, as long if you are doing the actual expense for your car, and if you happen to have two cars, okay, let's say if your spouse doesn't work and you're the only one working, you want to alternate your car, right? Making both cars be business cars. So as long as 50% of the usage of the car is for business, that car is considered a business car, okay? So the threshold is 50%. So you got to keep very good record of how often you drive your car. So in that scenario, though, you would alternate your vehicle, your car, right? Today, you're going to drive car 1, and then tomorrow, you're going to drive car 2. Make sense? And if you drive a whole lot with this strategy, you could actually make 2 cars be your business cars, okay? And when that happens,